Hello, hello. It is Dylan Langei, branch manager and loan officer at Evergreen Home Loans here in Bellingham, Whatcom County, your number one rated lender in Whatcom County. And ignore the date down at the bottom right. I know it's October 1st. I'm late on my September mortgage update. I'll save you the excuses. But I really wanted to get some data and some of the slides we had Freddie Mac come up to Bellingham. Freddie Mac is one of the largest mortgage backers in the United States, them and Fannie Mae. We had them up in Bellingham for a realtor-driven class and a homebuyer workshop. It was awesome. We had about 60 attendees on the first class or workshop, real estate agents here locally, and then had about 30 on the second workshop. So really great turnout. This one is going to be a little bit longer, but stick with me. A lot of amazing facts and statistics from Freddie Mac and from another source, Keeping Current Matters, that I think will give you a really good insight into the market and what's going on. Of course, we'll cover mortgage rates, mortgage applications, all the typical stuff. And before we dive in, if you're watching this on YouTube, do subscribe to the channel. I post videos on new mortgage products. Yeah, I do a monthly video on just kind of rates, the market, what's going on. So make sure you subscribe to that. And then always check out WhatcomHomeLoans.com if you are looking for anything regarding me, how to apply, testimonials, any of the previous videos or mortgage updates, anything like that is on WhatcomHomeLoans.com. But all right, let's dive into it. And because we've got a lot of really great stats that I want to go through. And I'm going to try to go through them as quick as possible. I did write down certain pages that I want to go through on this. So the quick nugget this month are my ahas from the Freddie Mac workshops. Okay. I was in both of the workshops. Like I said, one was driven towards real estate agents in this community. The other one was specific to home buyers. So I kind of had two different insights, which was great to see. And I want to show you guys this, and I will attach this PDF for you as well so that you can take a look at these. So I'm just going to skip to the pages that I wrote down. So the biggest thing that I saw in this is, so millennials, there are 70 million millennials. And I think that a lot of people, when they think of a millennial, I always make this joke. They think that it's this little kid that's like spray painting the side of a building or doing TikTok dances. It's absolutely untrue. And I take offense to that because I'm a millennial and I don't spray paint buildings. But millennials are in that like 25 to 45 range. I should have pulled it up. It's somewhere around there, 25 years old to 45 years old. Okay. And I'm probably off by a year on that. But these people, this is the biggest population. There's 70 million millennials and only 20 million of those are homeowners. So you're talking about 50 million people from the age 25 to 45 that are not homeowners. And look at this, millennials net migration between states. So talk about sheer demand in Washington, which is where I'm at, and predominantly where my lending takes place. It is the biggest migration out of any state, right? Virginia is pretty close here, but out of any state that I can see, maybe someone will comment that I missed something, but right, 62,000. I mean, that's crazy, right? And reasons that they're reasons to move among millennials by marital status. Wanted newer, better housing, new job or job transfer, right? A lot of remote work. So people are migrating towards, cheaper, quote unquote, cheaper areas and, has a lot of amenities, right? The ocean, the rivers, the hiking, biking, all that kind of stuff. Wanted to own a home, not rent, establish own household, cheaper housing, right? All of those reasons. Share of mortgages issued to millennial buyers. 58% of mortgages were millennial buyers. So once again, you got to get that out of your brain that millennial buyers are the TikTok dancers that are spray painting buildings. They're just not. They are buying homes. They're the largest buying population in Washington and in many of these other states as well. So very, very important. Millennial renters want to become homeowners in the next 2 years. So once again, I'm sharing these, and maybe you're watching this video. You might be a potential home buyer. You might be a real estate agent. You might own a home already, right? I'm just sharing a lot of these stats because it just shows why the demand is so high in Washington specifically and who the demand is coming from. Because if you're a homeowner and you want to sell, You want to know how to market your property. You want to know who's going to be coming through that property. You want to know what they want, what they don't want, right? It's really important. If you're a home buyer, you want to know who you're competing against, right? If you're a realtor, all of this matters, right? If you're another lender, all of this matters. So consumer type. So millennials, 82% have not owned a home in the past. So they're first-time home buyers. Yep, not a big surprise. 58% will be 31 to 40 years old when they purchase their first home, right? Are you marketing to those people properly? 54% of millennials who are renters want to buy a home and anticipate to move in 2 years or less, right? 56% are saving for a down payment. 47% would use personal savings. 82% are confident they'll be able to manage their finances as well. 70% would consider single-family home when they move next. That is very important. Single-family homes are the most in demand. Okay. Let's go at number 8. Millennials are more educated than previous generations. Very highly educated. But it also, I believe, personally, postpones a lot of that marriage, kids, buying a home, because a lot of them are in college or grad school or getting their PhDs, right? When you have the baby boomers who maybe didn't go to college, right, or maybe went back to college or something along those lines, it's different, right? You're maybe having kids earlier, getting married earlier. So when you look at millennials, if they're, going to college and grad school and all that, it may postpone some of those buying decisions. So it's an important stat to know and understand. Millennial debt. So student loan debt is a huge thing. The cool thing about Freddie Mac is if that student loan debt is in deferment, right, you're not paying on it, you only use 0.5% as a monthly payment for the debt to income for qualifying, right? Fannie Mae requires 1%. So they give you a little example here. But student debt, a lot of people think I have student debt, I can't buy a house. 100% not true. A lot of my home buyers have student loan debt. Down payment is the biggest barrier. A lot of people think you need to put 20% down. Absolutely not true. There's programs 0% down, 3% down, 5, 10, 15, 20, 25, so on and so forth. But very low down payment options. Financial literacy. It's crazy that it's a big impediment. 47% of first-time homebuyers ages 25 to 45 lack of knowledge regarding the home buying process as a barrier. Yet they're the most educated in school, right? College, grad school, all that. It's pretty remarkable that they're not financially literate. Types of tools, right? This is really important. Where do people go to learn about buying homes? It's very important to know that. I thought it was pretty jaw-dropping. A lot of it is real estate websites. A lot of it's real estate agents. A lot of it's family. Right? What's interesting is you don't see lender on here, the ones who are giving the loans. It's pretty remarkable. Where's the media channels, right? Where are they going? So if you're selling a house, if you're buying a house, if you're a real estate agent, this is where people are going by generations, right? So your millennial generation, the biggest buying population, YouTube is the biggest one. Facebook is second. Instagram is third. Snapchat, Twitter, TikTok, LinkedIn, all after that. Tumblr. Let's see here. So that was kind of the biggest aha moments. There's a lot of millennials. They're going to be buying soon. Another thing was what's really cool about some of these Freddie Mac products is there's a tool that you can look at, and it's Freddie Mac AMI income tool. So let's just do area median income. So if you are a first-time home buyer and you make at or under 100% of area median income, you actually get a pricing break. There's also some mortgage insurance breaks. So let me just do my office, Berkeley Boulevard. Okay. So you just type in your address wherever you are in the United States. So 100% area median income. If you make under 102,600, right? Let's say that you have subpar credit, you're buying a condo, anything that would add to the mortgage pricing, it actually goes away if you're under that. So contact me if you have any questions specifically on that. But Fannie and Freddie are trying to make home affordability more attainable, right? Trying to make home buying more affordable. So it's pretty cool, some of the things that they're doing here. All right, keeping current matters. I think this is huge. My biggest takeaway, and you'll see this will be validated by some of these statistics, is that right now people are buying out of necessity. Life changes. During COVID, when rates were 2.75, people were buying anything because rates were 2.75. They were working from home, two parents working from home, having more kids, dog, whatever. You were at home more. People are now out and about, going back to restaurants, going back to work. You're not seeing that, but you're seeing people buy because of job relocation, weather. They want hotter weather, colder weather, right? Natural disasters, having more kids moving out, kids going to college. Right? These are necessity changes, right? People are not buying just because, oh gosh, rates are 2.75. However, where the huge opportunity that I'm seeing with my clientele, first-time home buyers and move-up buyers. The thing with first-time home buyers is they're paying 100% interest, because they're paying rent. And then move-up buyers, especially in Whatcom County, Bellingham, if you've got that $500,000 to $800,000 house, that's a highly desirable price. Selling that home and buying the $1 million plus or the $800,000 plus, that's where you're getting a deal. That's where you're seeing some price drops. That's where you're seeing seller credits. That's where you're really seeing that, that leniency. So those move-up buyers. The other thing is mortgage rates will come down and buyer demand will go up when that happens. So I think there's an amazing opportunity for those move-up buyers and the first-time home buyers or the people that need to buy out of necessity. If your home is perfect the way it is and you're not having more kids or kids aren't moving out, you don't need to move, by all means, don't move, right? This is not a public service announcement that everybody needs to buy a house, but there's definitely pockets that it makes sense. The other thing is home appreciation is down, but home values are not. They're just not appreciating at 20% year over year like they were during COVID. Buy for location. I've always said that, buy for location. Don't buy for, features or price. I mean, obviously look at those. I always say there's three things: location, price, and features. In this market, with this low inventory market, you can typically get one. Buy for location. Location matters. When that appreciation, softens, those areas that are not the best location, maybe you have the nicest house in the worst neighborhood, that home gets hit the hardest. The home that's maybe not the nicest, but it's in the nicest area, that home is okay. Because if you think about it, your home is actually not going up in value. It's the land, right? It's where the property is. Of course, if you remodel and spend a lot of money, maybe you're not getting the same amount of money for what you put in, but location matters because that land is becoming more valuable because of where it is. If it's the worst piece of land, it's not going to become as valuable. Okay. For sellers, buyers do want new and fairly dialed in. So it kind of contradicts what I just said, but this is just on the seller's side, and that was on the buyer's side. Buyers buy for location. Sellers, during COVID, I saw a lot of buyers that were like, oh, this is the worst house in a pretty good location. I can borrow money. I can do a cash out refi. I can get a HELOC and fix this home up because rates were cheap, right? Borrowing money was cheap and there was a lot more disposable income because inflation hadn't really kind of eaten into all that. People were getting PPP loans, all that good stuff too. So there's more money. So right now, people want a dialed in house. They don't want the house that's a total fixer and beat up if it's not priced well. I'll give that caveat if it's not priced well. Okay. So let me show you a few things on this keeping current matters. This is for August, but I think it's really, really important. There's 95 pages. I'm going to send this out. But what I'm hearing a lot with people wanting to wait to buy a home is because I keep hearing talks about, well, prices are going to go down or mortgage rates are going to go down, so I'm going to wait. Okay. Let's see. So, and you're not alone. 37% of people thought home prices were going to weaken. So you're not alone there. Consumer confidence. The talk of a repeat of the 2008 crash, right? It happened a lot during the pandemic, okay? But there's been a lot of talk about a 2008 crash. If you are somebody that didn't live through that, which I didn't really, I was in high school, but if you're somebody that did, you know what it was predatory lending. It was a very different circumstance. We have low inventory. That's the difference. And we don't have predatory lending. Okay. That's the big difference right now. We don't have a lot of foreclosures, which I'll show you the statistics if you don't believe me. So new listings. Everyone thought, oh, I'm going to wait for summer, right? It's October now or September-ish. A lot of people in spring were like, I'm going to wait for summer. The home buying summer. It's going to be great. All these listings are going to come up. That's not what happened. It went down. The reason why I think truly is mortgage rates. A lot of people have a 2.75, the golden handcuffs, right? So, people are kind of staying put. Foreclosure. So this is for the people that think I'm going to wait to buy because, 2008 is going to happen. I'm going to get a deal. 2008, people were losing their jobs, losing their homes, foreclosure filings. I mean, look at that. Look at where we're at now. I mean, this even surprises me. 186,000. This is nationwide too, right? I mean, it's down so much. It's not the same. It's not the same cup of tea. Serious delinquencies, right? I mean, this is probably you had a little bit from forbearance, right? But look at how low it is now. In June of 2023, under 0.6%, near 0.5%. It's just not happening. It's not true. I got to go to, let's see, 22. So this is price movement. So in 2022, right? And this is national. So Bellingham is totally different. Negative 0.6. You just got to be really careful with national headlines is kind of what I'm seeing on this. 28. Look at this. If you didn't buy before COVID, during COVID, you missed out on 20, 40% equity. I had people during COVID, the market's going to crash. I'm going to wait. They waited. They lost out. They kept their money in the stock market. Stock market was looking good early COVID. But now you're seeing swings of 10% up and down. Home values are not doing that. So it's interesting to me when I have a first-time home buyer that's got, several $100,000 in the market and they won't buy a home because they're worried about home values. Look at the stock market, and of course diversify. This is not the person that owns a home and has stuff in the stock market. I have money in the stock market as well, retirement accounts and all that. But when you've got money in the market, and you don't own a home. It's just interesting. So 28, let's see, 32. So deceleration of appreciation is not the same as home prices depreciating. So that's what I was talking about. Inventory down 50% since the same week in 2019. We have an inventory problem. Home values are not going down. We don't have enough houses. There's so much pent up buyer demand. Remember, 50 million millennials. There's simply not enough homes for sale. And that's truly the problem. Mortgage rate projections. So, I think this is great. We need a softening. I mean, we're seeing mortgage rates up near, in the 7 to 8 right now. We need them to come down. We either need home values to come down, income to go up, or mortgage rates to go down to help with this home affordability problem. Fannie Mae, MBA, NAR, average of all three, they're thinking it's going to come down. Once again, see this as a good sign if you buy a home now. If you wait for these mortgage rates to come down, those 50 million millennials and other generations are going to pop into that market, and it's going to drive home values up, right? It's a simple supply and demand, okay? I know this is a bit of a longer one, but these stats are really, really important. Mortgage rate, I've talked about this in previous videos. Mortgage rates follow inflation. Look at the CPI, follow inflation numbers. You can see back here, the green line's the 30-year fixed mortgage. It follows inflation. The Fed's trying to get a hold of inflation. They've done a decent job. It was up near 9%. Now it's down to 3 to 4%. They want it to get down to 2%. We really haven't seen a softening in mortgage rates because we also have a debt problem in the United States. There's government shutdown issues. I think we're going to see some relief here. Fingers crossed here soon. But we have to get a hold of the inflation problem. New homes are selling fast. This is to my point. People want a dialed in home. They don't have disposable income to fix it up. They just don't have that extra cash. So if you're a contractor, new home builder, if you remodeled your home, that thing is going to sell quickly. 68% of distressed property sales, right? Oh, I'm going to wait for 2008 to happen again. I hope it doesn't happen. I really hope it doesn't. But it's not anytime soon. Sorry, this got all funky. So let's look at home prices. Right, and this is national. So West, I think you've got California weighing this down quite a bit. Change in sales, though. So this is where the news media will say, home sales down, right? And everyone will think, oh my gosh, the real estate market's tanking. It's because of inventory, right? Change over change in sales is they're looking at the amount of homes that sold, the same week of 2022 or 2020. Well, it's because there's not as much inventory. So that's why, so you have to be really careful with headlines. Change in home prices, right? If you didn't buy, like I said, before COVID, even if you bought back here in 2012, look at this change in home prices. You still made about 5% in this, quote unquote lull. Made a good amount here. You made 20% during COVID. If you didn't buy a home, look at the stock market compared to this. It's had some good months and years, but it's also had some bad. I look at my stock portfolio. I was up, I purchased a lot right during COVID, did a lot of like hotel stock and all that because I knew it'd be back. Went up, 40%, 60%, and then back down. So home prices, though, have gone up. So at least you have that stability, right? This is for people that don't own a home. Change in home prices, right? This is all kind of more the same. It's gone down. You're not getting 20% appreciation. I like that. We cannot have 20% appreciation. People's income is not going up by that much. Year over year change in price, right? That's the forecast. So buying real estate is still, I think there's still some good opportunity right now. We're getting some more inventory in Washington, right? That's statewide though. So it depends on the market you're in. Months of inventory. This is what I'm talking about. We don't have enough inventory. Nationally, we're at, 3 months? That's crazy. So it's crazy low. In my market, we have even less than that. Months of inventory again. So there's not enough inventory. There's a lot of buyer demand. So, still a great time to buy. One more thing. Mortgage rates, kind of the expectation where they're going. It's going to create more demand. It's going to lower the inventory that we have. So be very, very careful waiting. That is my 2 cents. Let's get into the rates. So here's what mortgage rates are looking at. 7 1/8, you're paying 2 points. 2 points is 2% of your loan amount. So if you're borrowing $100,000, that's $2,000 in a closing cost. I ran this on a $700K purchase, 10% down with 780 FICO. You're seeing mortgage rates. I like this one. This is Freddie Mac's kind of U.S. weekly average. So they've gone up in the last month for some of those things that I talked about earlier, the debt in the United States and potential government shutdown. Some of those fears, it looks like that may have been figured out. So once again, this stuff could change by the time I send this video out. Applications, we had a week where they popped. Overall, they're down. That's driven a lot by mortgage rates. So supply and demand, right? Up and down there. Internal turn times, we're still closing loans very, very quickly, 3-4 weeks. Can do them in 2.5 if needed. Once again, we're in a low inventory market. It's still competitive out there. The good houses are selling. If you've got a crappy house in a crappy location and you overprice it, weird, it's sitting on the market. If you've got a good house that's dialed in and you've got a great real estate partner and you price it well, you're getting multiple offers. So that's my 2 cents. I know this one was a little bit longer. I'm going to send these PDFs out. If you're just watching this on social media, though, contact me. I'm happy to include these PDFs from Keeping Current Matters and Freddie Mac. Thank you again for tuning in. Make sure you do subscribe and or check out WhatcomHomeLoans.com. See you next time.